February 21, 2026. The focus is slowly shifting. Not in headlines, not in markets, but in policy rooms. The Federal Reserve is now under pressure, not to react fast, but to react correctly. Inflation has cooled, not disappeared. Prices remain elevated, but the pace of increase has slowed. This creates a dilemma. Keep rates high and growth slows further, cut rates too early and inflation risk returns. The Fed's challenge is timing, and timing is everything at this stage of the cycle. Interest rates remain restrictive. Borrowing costs are still high. Mortgage demand remains weak. Business loans are more selective. Credit is available, but not cheap. This affects decisions. Companies delay expansion. Households delay purchases. Not because they are fearful, because they are cautious. The economy does not stop. It recalibrates. Markets continue to anticipate rate cuts later in 2026. Bond yields move on expectations. Equity markets respond to liquidity signals, but expectations are fragile. A single inflation report, a single employment surprise, can change sentiment quickly. The labor market remains the key variable. Jobs still exist, but momentum is softer. Hiring plans are conservative. Wage growth is stabilizing, not accelerating. This helps inflation, but limits consumer upside. Productivity gains from technology are improving output. Artificial intelligence continues expanding, but productivity does not always mean job security. Some roles grow, others fade. Transition creates uncertainty, not unemployment, uncertainty. Consumer behavior continues adjusting. Spending continues, but priorities shift. Necessities first, discretion later. Households focus on cash flow. Debt service matters more than asset prices. Credit card balances remain high. Interest costs remain painful. This reduces tolerance for surprise expenses. Housing remains a constraint. Supply is limited, prices are sticky, affordability is low. Mobility is reduced. When people cannot move easily, economic flexibility declines. Government spending continues supporting growth, but fiscal space is narrower. Debt levels are high, interest payments consume resources. Future flexibility becomes limited. This increases reliance on monetary policy, which increases pressure on the Federal Reserve. Globally, conditions remain uncertain. Energy prices fluctuate, geopolitical risks persist, supply chains continue adapting. The strong dollar attracts capital, but pressures exports. Manufacturing growth remains uneven. Some regions benefit, others lag. Small businesses face tighter credit, higher costs, lower pricing power. Margins compress. None of this signals immediate recession, but all of it reduces margin for error. This is the phase where shocks matter more. The economy can absorb fewer surprises. Confidence matters more. Policy mistakes become more costly. The U.S. economy in late February 2026 is not breaking, it is balancing. Balancing inflation control, balancing growth, balancing debt, balancing confidence. The next moves by the Federal Reserve will not determine whether growth exists, they will determine how smooth the adjustment is. A soft landing is still possible, but it requires patience, precision, and time. Economic cycles do not end loudly, they evolve, and this evolution is still underway. The real risk is not slowdown, the real risk is misjudgment, because when margins shrink, small errors become big outcomes. Watching interest rates alone is not enough. Watch credit, watch employment quality, watch consumer confidence, watch small business behavior. These are the signals that move first, before GDP, before markets, before headlines. The U.S. economy is still functioning, but it is sensitive, and sensitivity defines this moment. February 2026 is not about fear, it is about discipline, understanding where the economy stands before it is forced to change direction. If you want to understand what happens next, look beyond the obvious numbers, because real economic turning points begin quietly and only later become visible to everyone.